Hello and welcome to the Investor Securitization Podcast. I'm Stefan Wagner, your host, and in this series we explore the cutting edge of investment innovation. In each episode, I sit down with leading asset managers who use securitization vehicles to execute their unique investment strategy. Our goal, to help you learn from their experiences, what works, what doesn't, and how these structures can unlock new opportunities in the financial markets. We will cover investment philosophy, market adoption, risk management, and much more. Plus, we will dive into why managers choose specific securitization vehicles, whether it is an actively managed certificate, an exchange-traded note, a performance-linked bond, or other innovative structures. So, if you are looking to stay ahead in the evolving world of finance, stay tuned and listen.
The Investor Securitization Podcast with Stefan Wagner, unlocking investment innovation. Vesta's end-to-end platform enables securitization providers and investment managers to streamline the life cycle of dynamic investment solutions, ensuring better results for their clients and their operations.
The best risk management system is just being able to do the calculations in your head and not have something that's full of so many complex instruments you can't really see where the downside is.
The information in this presentation is for informational purposes only and does not constitute an offer, solicitation, or recommendation to buy or sell any financial products. It is not intended as investment, legal, tax, or accounting advice. Always seek the advice of your financial advisor or other qualified professional regarding your investments.
In this very first episode of the Investor Securitization Podcast, I am thrilled to be joined by Jonny Matthews, the portfolio manager behind the global macro investment strategy at Fortem Capital. Jonny and I go way back. We first met in the 90s, sitting opposite each other on the Salomon Brothers trading floor, which later became Citigroup. After his time at Citi, Jonny went on to manage money for one of Europe's largest global macro hedge fund, where he refined the discipline and deep analytic approach that now defines his investment approach. It was during this period that he also built the foundation for his Super Macro newsletter, delivering institutional-grade market insight. Fast forward 20 years and our paths have crossed again, this time at Fortem Capital in London, where Jonny manages the Fortem Capital Global Macro Investment Strategy. I could not think of a better guest to kick off this podcast series. Join us as we discuss his investment philosophy, market outlook, and how he had to adapt from working as a trader at an investment bank to being a partner at a hedge fund. Let's get started. Jonny, thank you very much for joining me on my podcast. Jonny Matthews from Super Macro. Let's start, what actually inspired you, Jonny, to found Super Macro, and in a sense, how has it evolved?
Well, hi, Stefan. Thank you very much for inviting me on the show. Super Macro really was born out of necessity. I spent 12 years at Brevin Howard, and I left in 2016 and started managing my own capital. Now, I'd been used to having a team of Brevin economists receiving external research from consultancies like Oxford Economics, Pantheon Economics, and so on, and the investment banks research. And all of a sudden, I was devoid of all that. Now, it was, at the time when I was at Brevin, it was quite overwhelming, all this research. It was hard to see the wood from the trees. And what I wanted to do was be able to do my own research, look at the economic data, understand the investment implications, the implications for growth and inflation, and the outlook for the economy. So I started putting together my own spreadsheets, analyzing the data from Bloomberg, and trying to understand their implications on the investment environment. So I started doing all that research myself, and I got quite good at it, if I say so myself, and I was asked to provide a daily note for a broker. And the broker was going to provide my research onto their clients, obviously for a fee. After doing this for a while, and it was very popular, I wanted to branch out and expand my audience. I wanted to provide the research not only to professional investors, but also perhaps to high net worth individuals, high net worth retail investors. So that was really the birth of Super Macro, and it's grown from there. I tried to take the day's macroeconomic data, the important parts of it, and explain the implications and give my opinion on where things are going.
Mm. I mean, I find in general that writing things down makes things really clear, whatever you do. But in particular, in this case, a good discipline, and it makes it much clearer in your head, and you can work with that one, and then also explain it to others or pass it on to others.
Well, that was what I found. I should have said that was probably for me the greatest benefit. I found that having to write something down and explain it made me research it in much greater depth, gave me a much better understanding. And it really, really improved my investment performance. And I think the other thing, from my point of view as an investor, doing all that work on analysing data and researching and writing meant that I was never bored. I was never distracted. There were no trades that I did out of pure boredom, which was always a problem when
we have all been there.
Yeah, there are times in the market when it's quiet, there isn't really anything to do, and you get bored and you think, okay, well, I'll just have a punt. I'll short some S&P futures or something. All of that went away. I was just completely preoccupied with writing something that was good and readable.
What would you say for people who subscribe to your program? What are sort of their top 3 benefits?
Well, I think first of all, you're getting a summary of each day's most important economic data and the implications for markets, and you're getting an opinion from someone with 30 years of professional trading and investing experience and a pretty solid track record of success. So that's primarily what you're getting. I also provide a weekly analysis of what's gone on in the market and what I think is going to happen, and an analysis of a lot of different markets. So I hope I am bringing a very broad spectrum of analysis to people in a very concentrated way that you just wouldn't be able to get from anyone else.
I've been lucky enough to be the beneficiary of some. I get to see your reports. Question a little bit is like, there's so much data out there. Is it actually the more data you get access to, do you get better, or is the trick actually to cut out the stuff that is not meaningful?
Yeah, that is the trick. If you start analyzing every little component of the CPI, it gets boring, and B, it loses its meaning. So quite often I'll start off going through just about every component of the CPI, and then I'll edit it and narrow it down and try to focus on what's important. And it's also got to be readable. It's, I don't want to make it too sort of like trader speak.
Every profession has their own little lingos, doctors have lingos, traders have their lingo,
Yes, I might sneak a little bit of it in from time to time, but I want to make it readable and get the important points across.
Now, you're not only managing your own money and providing macro research to subscribers, but you're also now managing an actively managed certificate with your strategy in it. Can you a little bit describe what the ideas behind that strategy?
So I'd love to be able to say there is a process where I just go through this set bunch of procedures, pull the data into a great big filter, a great big hopper, and out comes 3 or 4 trade ideas. That's not the way it works. It is just a constant process of writing about what's going on in the market, and through that process, finding opportunities where the market has priced an outcome which is very, very different to how I see the world evolving. And for example, I was called the recession denier 2.5 years ago. I was the recession denier back then.
Oh, yes.
And I went on a podcast with Jack Farley on his forward guidance podcast long time ago, and said, there's no way there's a recession coming in the US. And I used to give presentations to US brokers, and they were laughing at me. They would laugh at me, and I really didn't change my opinion on this.
Why do you think the overall market was always consistently, basically, literally, I felt like hoping for a recession?
Yeah. To answer your question, why are people looking for that now? I think it's what psychiatrists call recency bias. There's a generation of traders who have grown up with rates pinned to the zero lower bound, with pancake flat yield curves, and with relatively slow rates of growth and low inflation. And we had virtually a decade of that, and I think people still expect that to return. And they also look at how some funds, like Brevin at the time, were incredibly successful by getting ahead of what was an oncoming catastrophe. And so people are always trying to be prepared for the next one. But I think you've got to look at the evidence that's in front of you. The circumstances now are very, very, very different to the run up to that last Great Recession. The amount of household and corporate leverage is nothing like it was.
Yeah, I mean, I still remember when I bought my first flat in London, interest rates were even higher than they are now, and it was completely normal. We're like, okay, that's what the mortgage rate is.
Absolutely.
Now everybody's having a heart attack about it. I'm like, okay.
Yeah, no, I can remember locking in I think it was an 8% rate for 5 years, and thinking I'd done really well. I was really pleased. So we are used to much higher rates of interest. There's a generation that haven't experienced this kind of thing and think the world's going to fall apart.
Now, in your research, there's a lot of always, I find, big focus on the US macro, so monetary and financial.
Yep.
Is that really drives so much still in the world versus anything else?
Well, it is. Certainly, it does influence the financial markets more than what happens in other corners of the world until something really blows up, something really significant happens somewhere. For the most part, if you look at the performance of most assets, the US dominates, really. It does dominate the investment landscape, and so that has to be the primary region of focus.
When you now come up with your ideas, you write, you get your ideas, you put them in place. How do you then sort of decide how much capital to allocate? How is your risk sizing in a sense? How do you approach that?
I typically size the trades so that I might risk as much as 1%, maximum 2% of capital in any trade. That's how I size it.
In the sense you stress it, or because you have convex instruments in it?
Well, first of all, yes. If they're just linear instruments, you can do the kind of calculations in your head. And I have to say the best risk management system of anything is really just being able to do the calculations in your head. If you've got something so complex and so convex that you need a really sophisticated risk management system to see what might happen under a certain set of circumstances,
with 50 different assumptions, correlation, covariance, and everything else,
that's not the kind of trade that I want to do. I like to have things that are relatively straightforward. Now, when it comes to convex instruments, as you say, if I was, let's just say, short a call option, maybe with a small hedge, I always have done this. So, within a spreadsheet, you can stress the underlying spot, move it up 10%, down 10% in 1% increments and look at the P&L impact. And that is how I do it.
Speaking about what can go wrong, maybe you have a little bit of a war story about one of your worst performing investments, or that, and what you learned from it.
Well, I've got, there's two things I can talk about actually, but they both taught me the same lesson at the time. One, I didn't actually lose any money, but this must be the worst trade I ever did. It was during early in 2008. I'd had a great run of P&L in 2007, and by the summer of 2008, things were going very, very well. And I was called up by a sales guy at an investment bank that will remain nameless, but they are very, very good at recycling their risk. They take on risk and recycle it. So the salesman said, we've done a lot of option trades in platinum, and I know you're this brilliant option trader, brilliant volatility trader. We are bidding 80% implied vol for a 1 month variance swap on platinum. And I didn't really know much about platinum at all. But the long and the short of it was I agreed to sell, I think it was $100,000 of Vega in a 1 month variance swap on platinum. So this variance swap was based on the daily London fixing. And the first day after I'd done this variance swap, bear in mind, there were only 22 readings. I think it was a 1 month thing. There was only 22 daily fixings. The first day's print was down 15%.
Keeping the point that 1% is 60%
I was doing the calculations in my head. Yeah. So I'm thinking, that's 240 vol, and it's like 240 squared minus 80. Oh my, it was horrible. But then after that, it just died a death. It kind of crashed and just virtually flatlined for the next few days. And within about 10 business days, this variance swap was back on side, was actually showing a small profit. And I unwound it. I just thought this was the dumbest thing I've ever done in my life. Even though it was small size, it was just stupid. But that, I got out with a small profit. The same investment bank persuaded me to sell strangles on dividend swaps in, I think this was probably 2006, 2007. Dividend swaps were being bid higher and higher and higher to crazy levels. So rather than just selling a long-dated call on the dividend swaps, I thought it would be more sensible, or they thought it would be more sensible to sell, an out-the-money call and an out-the-money put. And the dividend swaps got even crazier when, they were just getting bid higher and higher and higher, getting close to the upper strike, the striker by strangle. And I hedged by buying a dividend swap. And then as we came into 2008, the whole lot collapsed, absolutely collapsed down to the put strike. And I had to sell this dividend swap that I bought and go short. I think I just unwound the trade, cut it, and that did cost a lot of money. And what did I learn? What did I learn from it? I learned that actually when a salesperson from an investment bank phones you up and says, well, we've got this great strategy, we think you should take a look at it, you should really look very, very carefully at what you're doing.
As I mentioned right at the beginning, you decided, or it was decided in the sense to use deliver the strategy in form of an actively managed certificate. Maybe a little bit for our listeners, why did you actually choose that vehicle?
Well, for me, primarily it was the ease and the speed of setup, the availability of an infrastructure that was already there with Fortum Capital. I did previously look at setting up a hedge fund. The requirements nowadays are quite onerous, and the timescale involved is just massive. And unless you've got at least, I would say, 250 million of capital behind you, you can forget it.
Yeah, I mean, we see this all the time. People can launch a product with this like for 5-10 millions and start building a track record and prove the point. And for example, I mean, I used to have to deal with the fund regulators as well, and it took them 6 months to prove something. And particularly if you wanted to bring out something thematic, like by that time the theme was out of already. There was nothing left. There was no premium for you to carve out anymore. And I mean, time is money here.
Yeah, exactly. And it's very, very difficult to start off on a small scale and build up because the overheads are just too great. So the AMC route was a very easy route. I had a 4-year track record of managing my own personal capital, which looked very good. And with that, it provided us kind of launch pad to get this AMC off the ground. And the great thing about an AMC is it suits my style of trading. These days, I stick to very, very liquid products and simple strategies. And the AMC is, you have the daily mark-to-market, daily liquidity. Investors can get in and out as however they like. There's no gate, nothing like that. It's very convenient for the investors, and it suits my trading style.
Now go a little bit more philosophical, a little bit. I mean, we both used to work at banks, and it was like, trades would come in, or you were asked to show which side you are, basically. But going then to a fund where, yes, you have the capital, but which trade do you start off with? You know what I mean?
Great question. It was, to be honest with you, extremely difficult, and I really didn't know what I was doing. If I'm truthful about it, once I joined Brevin Howard, I was struggling. You go from an investment bank where there was this tremendous amount of margin on every trade that we did, and capturing that bid offer flow was a continuous, almost like an annuity revenue for us. On top of that, I could then do my own, if you like, proprietary trading, and that mainly comprised of just being long convexity, paying away theta each month to be long convex exposures to the market. And I could afford to pay that premium that it cost each month, because I had the customer flow that was, more than offsetting it. So every month I would show a P&L that was okay, even if nothing much happened. And whenever some big event happened and these convexity positions paid off, I would think to myself, wow, what a great proprietary trader I am. I'm so good at making money. Really, we were kidding ourselves. And then when I moved to a hedge fund, it was much more difficult. You start with a completely clean sheet, and whatever trade you do, whatever trade one does, you're paying away bid offer spread to put the trade on. So you're offside from day one.
Yeah, you're underwater the minute you put the trade on.
Yeah. And I started off very cautiously. And in fact, I was primarily doing relative value volatility trades. And I became more and more aware of the importance of looking at the macro and how the macro can overwhelm all these relative value factors. And at the time, 2006, US housing market was going crazy, and it was beginning to stall. And leverage was, household leverage was through the roof. People were buying houses with no deposits. People were buying 5 or 6 houses with no deposits. I was reading about waiters in San Diego earning, $400,000 condominiums, but not just one, like 3 or 4 of them, and while they're earning $20,000 a year. There was crazy stuff going on.
We all remember The Big Short, where he interviews in a certain establishment. How many?
It was glaringly obvious that a disaster was going to happen in 2006. So I began to look more at the macro data and focus on that and prepare for the coming onslaught. And it was quite astonishing, actually, at the time, that people were willing to sell risk protection at lower and lower prices, regardless of how crazy things were getting. People wanted to collect premium for insurance against disasters. And in every aspect, whether it was AAA rated mortgage-backed bonds that were trading at ridiculously low spreads, or credit spreads, CDOs, collateralized debt obligations, and corporate credits, all this kind of stuff was trading at crazy low prices, crazy low spreads. And the same for variance swaps. So I just really loaded the boat with these type of products, these types of risk protection. And when 2008 came, they started to pay off. And so from that point on, after making some money in 2008, when the world blew up, not as much as I should have done, I got out too early. But in 2009, you really could have picked almost any asset that you like the look of, really, whether it was credit, whether it was dividend swaps, whether it was just outright equity, everything had been smashed to pieces, and you could really just take the pick.
Very attractive price. Yeah. I agree. But everybody or many people were scared. Now, listening to you, saying, about protection or whatever, there's always these, I get into this discussion with people, what's the difference between betting and investing? You're an experienced poker player. So is there a difference in your mind, or what is it? Because, we always deal in probabilities, and that's always the same.
No, I think it is very similar. It's very much the same in poker. You can tip the odds in your favor, but you can always find yourself having a game that really doesn't go your way at all, regardless of how good you are. And regardless of how well you understand the psychology of the other players and the probabilities of the cards, things can always go against you. For me, one of the most important aspects of risk management is taking losses. And I've got to tell you a story. I used to have to do investor meetings when I was at Brevan Howard. I remember going into this conference room, sitting at the head of the table, surrounded by a bunch of investors that were doing their due diligence for some pension fund. And I spoke about what I did, what my opinions were on the economy and everything. And then they started questioning, it was time for them to ask questions. And one of them said, what is it that makes you a good trader? What is your best attribute? And I said, well, I'm very good at losing money. And you can imagine there was a silence in the room. There were pencils being dropped. and then I went on. I mean that, when it comes to taking losses, I'm pretty good at cutting losses, because a lot of traders will think, I want to hang on or gamble, gambling for redemption, increase the trading size to try and get it back again. That is just the worst thing that you can do. As a trader, as an investor, or as a poker player, there is always going to be times when things go badly, always. And you need to be able to just detach yourself from the painful psychology of that experience and just say, right, I'm going to put a line through this. I'm going to get out.
You talked about, the discipline of writing things down makes, clarifies things in your mind. Is there other things or sort of processes and structures that you set up that help you to be more efficient, or do you have a certain environment, you have a certain routine? Or
I do have a routine. My day starts very early. I will finish off my daily notes with any new information that's come in overnight, and then we get the notes sent out at about 6 o'clock in the morning, London time.
Wow. Okay.
Yeah. So then, the most important day's data is typically from the US, which is not till 1:30 London time. So I have the morning when I'll see the European data, but also I'll have the opportunity to read through other research reports from other people and do my own analysis on whatever else has been going on, a more detailed analysis of the data. So that is really my daily routine. And the great thing about that is that for most of the time while I'm doing this, I really am not looking at prices on the screen moving up and down. And I think unless you've been a trader, you won't realize how distracting it can be. So for me, I'll have a glance at what's going on first thing in the morning, looking at prices and update myself on what's happened. But after that, I'm really focused on writing the note and researching. And that's a much better routine than just coming into the office each morning, looking at what's going on the screen, trying to read a bit of research in between, glancing back at the screen to look at the data.
No, quick question for you.
Yeah.
What is your definition of success?
Definition of success is doing what you want to do and being happy with your lifestyle.
What is on top of your current music playlist?
My music playlist is very, very diverse, and
excellent.
I like to listen to contemporary music, as well as classical music and Wagner operas. And if you ask me, that was when rock music started with him. And my favourites are, David Bowie and the Rolling Stones and all that. But I like to listen to contemporary music. And every so often an artist comes along and I think, wow, that's different, that's good. So it's kind of embarrassing, what I listen to these days. Sometimes, I'll listen to Lizzo, I'll listen to Tovolo, DJs called Flight Facilities. They made a lot of great electronic dance music. Pizza Guide by Touch Sensitive is a brilliant, brilliant track. I'd recommend to anyone. I've got
Excellent.
I could go on. My musical tastes are all over the place.
Last question here. If people want to get in contact with you, what's the best way to reach you?
Well, the website is super-macro.com, www.super-macro.com, or you can follow me on Twitter. If you search for Super Macro, hopefully you'll find it. And, watch out on Twitter for our podcast that I do with Elvis.
Excellent. Thank you very much. Much appreciated.
It's been a pleasure. Great to chat with you again, Stefan.
The Vesta Securitization Podcast with Stefan Wagner, unlocking investment innovation. Vesta's end-to-end platform enables securitization providers and investment managers to streamline the life cycle of dynamic investment solutions, ensuring better results for their clients and their operations.
The information in this presentation is for informational purposes only and does not constitute an offer, solicitation, or recommendation to buy or sell any financial products. It is not intended as investment, legal, tax, or accounting advice. Always seek the advice of your financial advisor or other qualified professional regarding your investments.